Good morning. I'm extremely delighted to be here. Particularly for the reason that here we have the presence of the participants and the leaders from the real sector of the economy as well as the financial sector of the economy. And this is a unique event in that sense, the FIBAC, FICCI and IBA coming together to organize this event. And therefore, I have a sort of a prepared speech, which is for about 20-25 minutes or so. And the copy of that will be uploaded in the RBI website immediately after my speech is over. But in between, I may deviate and make a few points here and there, depending on the level of, the response of the audience which I see. So may I now start by saying that Sri Subrakant Panda, President FICCI, Sri A.K. Goel, Chairman IBA, other distinguished persons and dignitaries on the dais, respected members of FICCI, IBA, and leaders and other participants from both the financial sector and the real sector, ladies and gentlemen, members from the media who are present here. Once again, a very warm good morning to all of you. I'm indeed thankful to FICCI and IBA for once again inviting me to participate in this FIBAC conference. This is the third event I am participating. The first one was in 2019, then again last year, and now. As momentous changes are taking place in the financial and business landscape, events like this provide us an opportunity to industry leaders, bankers, and policymakers to deliberate on issues of our times and crystallize our thoughts for future guidance. Today, the world is grappling with an unrelenting and unending string of challenges since 2020. Geopolitical conflicts, geoeconomic fragmentations, volatile commodity prices, uncertainty in trajectory of monetary policies and their macro-financial implications, increasing frequency and ferocity of climate shocks, all these prevailing together present a very complicated and, should I say, deadly mix of challenges. And these challenges are not just for policymakers, but for every player who's there in the business world, every player who is there in the industry world, every player who is there in the financial sector. Historical regularities are looking improbable and policymakers are being put to test. In this backdrop, the theme of today's conference, Winning in Uncertain Times, aptly captures the long-standing quest of humanity to make progress against all odds and challenges. I am an optimistic and I remain confident that we can work together and navigate through this stormy weather. In tune with the theme of the conference, I would like to touch upon the Reserve Bank's policies and actions in the last 1.5 years in particular to maintain macroeconomic stability. I would then proceed to talk about India's growth drivers and emerging opportunities that can be harnessed to enhance India's potential growth. In the end, I propose to highlight certain key issues which merit attention of banks, NBFCs, financial sector entities, and even businesses. The monetary policy actions of the Reserve Bank over the last 1.5 years, consisting of prioritization of inflation ahead of growth, and as you would recall, we did it in May 2022, or rather April 2022, we did it, that is prioritization of inflation ahead of growth, narrowing the liquidity adjustment facility corridor, increasing the policy repo rate by 250 basis points cumulatively starting May 2022 till now, draining out excess liquidity, together with certain supply side measures undertaken by the government, have facilitated significant softening of headline inflation to 4.9% in October 2023. The moderation in core inflation in particular is noteworthy. There is also recent evidence of household inflation expectations becoming more anchored. Headline inflation, however, remains vulnerable to recurring and overlapping food price shocks coming from global factors and local adverse weather events. The frequency and intensity of such shocks have increased in the recent period. Monetary policy in such a scenario needs to remain watchful and actively disinflationary while supporting growth. I must add that our actions over the past 1.5 years did not engender any financial stability risks as witnessed in some advanced economies in the early part of 2023. This may be attributed to the regulatory requirements prescribed by the Reserve Bank, which banks are expected to follow to manage their interest rate risk. These requirements act as safeguards for future stress that may arise when the upturn of the interest rate cycle takes place. So if you recall what happened in particular, let us say in the United States, I mean, from whatever I see from this distance, and this is something which is known to perhaps most of you, but just to explain what I was trying to say is that, a very interest rate increase of very high order in quick succession led to a situation where the banks and the other lending institutions came under stress. I don't blame the Fed for it. The US Fed was probably doing its job because they had to bring down inflation. High inflation is a challenge, is I think a complete no in the US economy. So Fed was completely focused on inflation. But the financial institutions and the banks, perhaps they had not adequately factored for the change in the cycle, for the cycle to turn down. That is, perhaps there was a belief that this low for long interest rates remaining low for long will continue to remain long and perhaps will continue to remain so till eternity. Now, that's a fundamentally wrong assumption. So therefore, whenever interest rates are low or any situation, I think one has to always prepare one has to always keep his balance sheet so resilient that it's able to withstand the shocks which may originate when the cycle turns. So I think perhaps that is something which happened, and lot of literature is already written on this. There will be more research as to what happened in the United States banking sector. But so far as the Reserve Bank is concerned, we are fully mindful of such possibilities because we have seen them in the past. And having seen them in the past, the Reserve Bank, as the bankers who are present here, they would very well know. We have, for example, we have prescribed capital and liquidity requirements, and we have made them uniformly applicable to all scheduled commercial banks, irrespective of their asset size and exposure. I'm talking about scheduled commercial banks. We have also investment fluctuation reserves requirement, which the banks and which the banks are expected to create, and they have created. We have also introduced valuation guidelines valuation guidelines on available for sale category of investments, and which are pretty stringent. And our approach has been fairly conservative in this regard. So therefore, so far as India is concerned, we did not see the kind of financial stress or the banking stress because our regulatory requirements ensured that the banks themselves had taken the required steps, and they were ready for a change in cycle and for a regime where interest rates are tightened and interest rates are increased by the central bank. Also, what helped was that our calibrated approach in increasing the interest rates. Recently, in a speech which I delivered in Delhi, those of you who are interested may like to have a look at it at the Kautilya Economic Conclave. There, the theme of my address was the interdependence between price stability and financial stability. Now, price stability is very important for financial stability. Financial stability is also very important to ensure price stability, and there is an interplay between the two. And in that speech, I have tried to explain and tried to demonstrate by using certain, recent examples how sometimes excessive focus on one at the cost of the other can generate potential stress. And I have argued that what is therefore required in all situations is to take a balanced approach. And you need, both price and financial stability, they need each other. But that balanced approach is necessary so far as policymakers are concerned, because financial stability ultimately is the backbone for any country's growth. And price stability also is something which impacts not only household consumption, not only the standard of living of the people, but it also impacts financial stability. So I'm not going further detail into that, but let me now move on. Now, on exchange rate front, I was talking about our recent policies and the recent situation that prevails. On the exchange rate front, the Indian rupee has exhibited low volatility and orderly movements relative to peers despite elevated US Treasury yields and strong US dollar. It's different that in the recent last 3-4 days, the US, the Dixie has sort of slightly softened, and the Treasury yields in US also have softened, but that's only in the last 3, 4, or 5 days. Now, movements in the Indian rupee are, as we see them, movements in the Indian rupee are consistent with the strength of the underlying macro fundamentals of our economy and the reassuring availability of buffers, that is the foreign exchange reserves, which we have built up. So I was just talking about, what I have just said. Let me clarify for, it's open to interpretation, but let me also make it very clear to my media friends and other analysts who are present here, and all of you who follow the, the monetary policy very closely. I'm not giving any forward guidance or indication so far as the next monetary policy is concerned, which is coming up on the, which is coming up on the 8th of, the announcement will be on the 8th of December. I'm not giving any forward guidance, but I would just like to slightly deviate, slightly, step aside and just explain to you our approach. I did say that inflation has moderated, but I did say that the overlapping and continuing shocks are, especially from food inflation, is causing tremendous volatility and can act and provide upward pressure on the headline inflation, because ultimately it is the headline inflation which is our target. Having said that, I also mentioned that core inflation has softened, and I think that is demonstrative. Somewhere I think that gives us the conviction that monetary policy seems to be working. Now, having said that, we are completely focused on the 4% target. I have said it again and again that we maintain an Arjuna's eye on the inflation target. We keep an Arjuna's eye on inflation, on inflation, and we are completely focused on inflation. But at the same time, let me just, say sort of make it a little nuanced, and let me sort of try to explain it in a different way. If you recall, the child Arjuna was completely, when Dronacharya was, those of you who have read Mahabharata, and I presume everyone is aware of what the Mahabharata is all about. Now, when child Arjuna was asked by Guru Dronacharya to focus, to take aim on that parrot which was there on the tree. Now, the other princes, the other Kaurava and Pandava princes, somebody said, I'm seeing the tree, somebody said, I'm seeing the bird, somebody said, I'm seeing the sky. It was only Arjuna who said that I only see the eye of the parrot. So the child Arjuna was completely focused on the target. Like that, the central bank is completely focused on the target. But think of another situation in Mahabharata when the youth Arjuna was was participating in the Swayamvara. He had to take aim on the fish which was rotating on the top, revolving on the top, and he had to take aim through the water. So he had to also completely focus on the eye of the fish because he had to hit the eye of the fish which was hanging, upside down. But at the same time, he had to see through the eye of the water. And there were ripples in the water. So he had to be mindful of what are the ripples in the water. What is the wind factor? How much of wind is there? The noise level in the room and the other distractions all around. And he had to still take the aim. He had to still hit the target. So while being focused on the target and committed to hit the target, he was also factoring in the other conditions which will enable him to hit the target. So therefore, like that, the Reserve Bank is completely focused on achieving the target, but we do consider several other factors which play their role in determination of our policy decisions. That is how we do it. Now, sometimes, a few persons have asked me that, when they have raised this question with me privately, that look, when you talk of this, you give us example of Arjuna's eye and explain things the way I did it now. Or when in one of my monetary policy statements, that was immediately last year, I think, after the death of the legendary Lata Mangeshkar, somewhere in my monetary policy statement, I mentioned that Aaj fir jeene ki tamanna hai. Or sometimes in my interviews, I refer to the need. Recently, for example, somebody asked me your advice to the financial sector and in particular to the banks. I said, play long term, play like Rahul Dravid. Now, I have been asked that, why do you do this? Doesn't it dilute the seriousness of the occasion? Now, I want to sort of use this forum and through you, convey to the wider audience. Now, what is the objective of the central bank? Central bank communication, and in particular, there is something called, I just read about household inflation expectations. Now, how is the household inflation expectations, how is it formed? It is formed by when the household goes in the morning to buy vegetables, when they go and buy the monthly groceries, it is impacted by the electricity bill and the milk bill, it is impacted by the house rent they have to pay, it is impacted by their real experience. Now, if it is impacted by their real experience, whether prices are going up or going down, now how does the central bank influence household expectations? The central bank can influence household expectations, inflation expectations, one, by taking actual action, that is increasing interest rates or tightening liquidity, measures like that, which are real actions, and backing it up with appropriate communication. Now, communication has to be in a manner that it reaches the wider audience, including the households. Ordinary households living in tier 2, tier 3 cities, and the level of interest these days, we should not assume that they are not aware of what is being said by people who are in authorities. When I take a flight, you will be surprised to know that, people who you would expect they're not aware of what is happening in the financial sector. They come up to me and ask, I was going through the security check. So that guy, the CISF Jawan was doing the security check, and after he completed, he said, sir, can I ask you a question? And this has not happened once. This has happened several times. I said, हाँ पूछो क्या है? What is that? So he told me कि sir ये जो interest rate आपने ऐसे किया, उसका what will be the impact on this? Now that is the kind of awareness that is so. That means he is reading the papers, he is following what we are saying, he is following what actions are being taken, and then I stood there for I sort of explained to him very briefly and told him कि look. I don't want to take more time because there's a queue behind me. They are getting impatient. So therefore, in brief, this is the position. And he was very happy. So therefore, if the central bank, which is to influence household inflation expectations, its communication has to be in a manner that it reaches the wider audience. Now, just imagine if I say that, we are completely focused on inflation targeting, but we to keep in mind multifarious factors, including global, domestic, local. Now, it's all right. I mean, the audience here will understand, but then what sense it makes to the wider audience? So when I explain it by using the simile from, from Mahabharata, the drop parallel to Mahabharata and explain it, Arjuna you in his youth and Arjuna as a child, I think at least I am convinced, I mean, somebody may not agree with my communication method, but I am convinced that I think we are reaching out to a wider audience. So that is why it is necessary that central bank communication in these times do play an important role. And over the last, ever since the COVID in particular, it was before that also it was there, but particularly after COVID, when the country and the whole world was facing multiple shocks, I and my colleagues in the Reserve Bank have been very, very careful in, in our communication to the wider audience. Now, as many business leaders are present here, let me now dwell upon India's growth drivers and the opportunities that lie ahead. The Indian economy rebounded strongly from the COVID-induced contraction of 5.8% in 2021 to a growth of 9.1% in 21-22 and 7.2% in the last financial year 22-23. India's real GDP is expected to grow by 6.5% both in the current year 23-24 as well as the next financial year 24-25, and that would make India one of the fastest growing large economies in the world. In fact, and quite interestingly, India is already the third largest economy in the world in terms of purchasing power parity. Despite global slowdown, the Indian economy has remained resilient and continued to grow due to its higher reliance on domestic demand, which enabled the economy to weather multiple global headwinds. Although India has made rapid strides in external openness through trade and financial channels and gained in competitiveness, India's dependence on domestic demand provides a cushion against external shocks. At the same time, various structural reforms implemented in the areas of banking, taxation, inflation management, and manufacturing sector, and similar other areas over the last few years have laid the foundation for sustainable high growth. We have moved from an era of twin deficit and twin balance sheet stress to the current period of twin balance sheet advantage. While balance sheets of banks witnessed significant improvement on the back of improved asset quality and profitability, corporates also display stronger financials, having deleveraged their balance sheets. The improved health of banks and corporates is also reflected in their recent second quarter results for 23-24. The corporate performance parameters based on 1,501 listed non-government financial companies. I repeat, the corporate performance parameters based on a survey of 1,501 listed non-government, non-financial companies suggest strong growth in profitability and staff costs in the second quarter of this year. The Reserve Bank's latest industrial outlook survey also indicates that business outlook has further improved, with manufacturing firms being optimistic about demand condition in the third quarter of the current year. Capacity utilization in the manufacturing sector on a seasonally adjusted basis continues to trend up, which augurs well for investment activity. Now, I saw also the FICCI survey, which was reported recently. I think it came out in the media, and I'm aware that your survey also perhaps gives out a similar result. The continued thrust on capex by the government is also favorable for investment activity. It is now for corporates and other businesses to evaluate the current situation and future potential of India and move forward. On the supply side, The agricultural sector has kept good momentum over the last few years, and its performance is expected to remain stable during 23-24, despite uneven southwest monsoon and lower kharif production. Production of fruit, food grains, as well as horticulture have reached record levels year after year. The diversification of exports, both in terms of products and destinations, is enhancing the economy's capacity to withstand the shocks. The agricultural sector continues to provide employment to a large part of our workforce. Now, there are, however, several challenges relating to productivity gaps, water usage and irrigation facilities, shifting consumer preferences, and sudden weather events, all of which do impact the agricultural sector. Now, all these require heavy investments in infrastructure and innovation to modernize the agricultural sector and realize its true potential for achieving higher productivity, more efficient access to markets, maximizing farmers' income, and increasing its contribution to the GDP. That is, increasing the contribution of the agriculture sector to GDP. As a nation, we must find a way of carrying out certain reforms, especially in the area of agricultural marketing and the connected value chains. These reforms are critical not only for sustained high growth, but also for durable price stability and to mitigate the frequency and intensity of food price shocks. It is important that private sector comes forward in a big way and becomes a crucial partner in this journey. There are opportunities for the private sector to invest in strategic areas of agriculture and allied activities such as supply chains, food processing involving variety of fruits, vegetables and food grains, scaling up dairy, poultry and fishing, and creating market infrastructure. Private sector can also accelerate farm to firm, that is agri-industry linkage, and improve the efficiency of the entire value chain right up to the end consumer. As regards the manufacturing sector, even as the share of the economy has been around, even as its share, that is the share of the manufacturing sector in the economy has been around 17 to 18% over the years, it has potential to accelerate its contribution to growth and employment. India's demographic advantage with its young population, with its young labor force, also presents a unique opportunity to become a key player in the global manufacturing. It is important for us to be part of the global supply chains which are undergoing realignments in the fragmented global economy. Initiatives like the production linked incentive, that is the PLI scheme of the government, create conducive conditions to enhance the share of manufacturing in our GDP. Sectors such as smartphones, large-scale electronics, pharma, food processing, auto and auto components have recorded good performance under the PLI scheme. There is also huge potential in emerging areas such as aerospace and defense, low carbon technologies, electric vehicles and semiconductors, and similar other areas. Our efforts towards building robust public digital infrastructure, which is fostering digitization and ease of doing transactions across the spectrum, will continue to provide strong fillip to technology adoption and productivity. At present, now I would like to turn to the services sector. At present, the services sector contributes the largest share in India's GDP and remains an anchor of India's overall growth. The Indian services sector is fast adopting new technologies such as artificial intelligence, Internet of Things, cloud computing, and data analytics to improve service delivery, reach, and competitiveness. The newly emerging startups are also largely concentrated in the services sector. There is a steady shift from low-skill, consumer-oriented services towards more technology-enabled business services. Indeed, there is a case for Indian businesses to recognize this undercurrent and work towards upscaling their activities to meet the external demand in this sector. In fact, India commands a strong external position thanks to the strength of our services exports, which have largely remained resilient. They have supported India's current account deficit, even as merchandise exports have been under pressure in the face of weakening global demand. The current account deficit to GDP ratio of India has remained under 2% for almost 10 years now. India's services exports are diversifying from information technology related services to other professional services such as business development, research and development, professional management, accountancy, and legal services. Overall, India's growth journey, with active participation of the manufacturing and services sectors and dependence on domestic demand, could be self-fulfilling in the years to come. Let me now turn to the financial sector. As the Indian economy strives to grow in an evolving and uncertain global environment, it is imperative that our financial sector remains strong. The Indian banking system continues to be resilient, backed by improved capital ratios, asset quality, and robust earnings growth. The financial indicators of non-banking financial companies, that is NBFCs, are also in line with that of the banking system as per the latest data available. While banks and NBFCs are showing good performance now, sustaining it requires concerted efforts. In good times like these, banks and NBFCs need to reflect and introspect as to where potential risks could possibly originate. Now is the time for them to further strengthen their risk management practices, build additional buffers to face the situation if the business cycle turns adverse in the future due to some reason. Now, we are quite optimistic about our business cycle, we are optimistic about our growth, but I think good governance, a good management practice would be to remain prepared if due to some unforeseen reason the cycle turns, then whether to what extent the balance sheet of banks, NBFCs, and other financial institutions are resilient. So basically, as financial institutions, they have to remain resilient at all times and resilient in all situations. On our part, the Reserve Bank of India has significantly strengthened its regulation and supervision of the banks, NBFCs, and other regulated entities in the recent years. We have also very recently announced a few macroprudential measures in the overall interest of sustainability. These measures are preemptive in nature. They are calibrated and targeted. It may be relevant to note that major growth drivers like loans for housing, vehicles, and the MSME sector have been excluded from these measures. Now, we have excluded them because at the moment, we don't see a possibility of buildup of stress. I'm not ruling out that possibility. But it was also a conscious decision to leave out certain sectors which are contributing to growth, because growth also needs to be sustained. We continue to focus on strengthening governance and assurance functions, ensuring effective risk management and robust lending practices. We are monitoring the supervised entities through various on-site and off-site tools, stress testing, vulnerability assessments, thematic studies, and data dump analysis, and similar other instruments. Now, this is being done as part of our proactive and forward-looking supervisory approach. Banks and NBFCs and other financial entities must continue to do stress testing of their books. They are already doing it. What I'm saying is that they must continue to do it. In fact, there is a strong case for companies in the real sector also to stress test their businesses and balance sheets. Many of them may already be doing so, but it would be desirable that many more also do this. At the current juncture, there may not be any immediate cause for worry, but to remain on top of things, banks and NBFCs would be well advised to take certain precautionary measures. In this context, I would like to highlight 4 points. First, while credit growth is accelerating in the current period, banks and NBFCs may take due care to ensure that credit growth at the overall sectoral and subsectoral levels remain sustainable, and all forms of exuberance must be avoided. Expansion of the credit portfolio itself and pricing of the same should be in sync with the risks envisaged. Banks and NBFCs also need to further strengthen their asset liability management. They may give greater attention to their liabilities side. In certain cases, we have observed increased reliance on high cost short term bulk deposits, while the tenure of the loans, both in retail and corporate loans, is getting elongated. Now, many banks are already doing it. I'm not saying that it's not being done, but as the central banker, it is our responsibility to point out and to ensure that every bank does it, and the banks which are doing it even do it with greater focus. Second, I said 4 points I wanted to mention. The first I have already said. Second, given the increasing importance of non-bank financial companies, that is NBFCs, in the financial system, the increasing interconnectedness between banks and non-banks merits close attention. NBFCs are large net borrowers of funds from the financial system, with their exposure from banks being the highest. Banks are also one of the key subscribers to the debentures and commercial papers issued by the NBFCs. NBFCs also maintain borrowing relationships with multiple banks simultaneously. Needless to state that such concentrated linkages may create contagion risk. Though the banks are well capitalized, they must constantly evaluate their exposure to NBFCs and the exposure of individual NBFCs to multiple banks. The NBFCs, on their part, should focus on broad basing their funding sources and reducing overdependence on bank funding. Third, microfinance has emerged as an important financial conduit to foster financial inclusion. As microfinance institutions, that is MFIs, are catering to the marginalized clientele, they have to bear in mind the affordability and the repayment capacity of the borrowers. Though the interest rates are deregulated, certain NBFC MFIs appear to be enjoying relatively higher net interest margins. It is indeed for macrofinancial lenders themselves to ensure that the flexibility provided to them in setting interest rates is used judiciously. They are expected to ensure that the interest rates are transparent and not usurious. Fourth, the increased collaboration of banks and NBFCs with fintechs is facilitating introduction of innovative products and services and new business models. Digital technologies are offering a powerful medium to access banking and financial services. This has brought down the operational costs and helped in enhancing the reach of financial services, of the financial service providers. An important aspect that merits attention in this context is with regard to model-based lending through analytics. Banks and NBFCs need to be careful in relying solely on preset algorithms as assumptions based on which the models are operated. These models should be robust and tested and retested periodically. They may require to be calibrated and recalibrated from time to time based on the changing contours of the financial ecosystem and fresh information. It is necessary to be watchful of any undue risk buildup in the system due to information gaps in these models, which may cause dilution of underwriting standards. Now, let me try and conclude. We are living in highly uncertain times in an interconnected world. New risks are emerging from time to time. New sources of risk are also coming up. In such a scenario, building up further on resilience would be the best insurance against shocks and uncertainties. This holds good for all businesses and financial entities. As I see many banking and corporate leaders in the audience, let me also stress that new opportunities are knocking at our doors. It is for us to capitalize them. There has to be greater focus on investment in capacity building, skilling of human resources, and adoption of newer technology by all players, whether from the real sector or from the financial sector. The international confidence on India's prospects is at a new high. It is an opportune time to make this India's moment and work towards strong, sustainable, and inclusive growth. Thank you very much.